we talk about stock dividends and we have to talk about dividends. What they are is it's the profits that are paid to the shareholders. Because you remember, the shareholders are the owners of the corporation. And the profits get split amongst all the shareholders. And how much you get is based off of how many shares of stock you own. You know, if you own 1 share of stock, you're going to get a much smaller amount of money from that company than if you own 1,000 shares of stock. Okay. Dividend income is just the money you receive from dividends. And you do have to pay taxes on it. We'll talk about taxes later, but you do have to claim dividend income. And it can range, it can range in anything from less than $1 per share to thousands. You know, you could get a check from a company for like 63 cents, but that would be your share. Or you could get, $2,000 or something. Stocks that pay dividends are called income stocks. So any stock that pays dividends. Okay. Not every corporation pays dividends. Some corporations operate at a loss, which means there are no profits. So they'll either operate at a loss or they'll operate as breaking even, in which case there are no profits, so you don't get dividends. Okay, and the yield of the dividends is like the percent value of the dividend as it compares to the individual stock price. And people analyze the yield because you can compare the yield from the dividends to the interest you would have earned in a regular bank account. To decide if the dividends are worth having your money there or if you'd be making more money if your money was sitting in the bank. So that's what the yield is really used for. The difference between an income stock and a growth stock is that people that are trying to use stocks for like growth stock aren't concerned, they don't concern themselves with the dividend income. Your money is being made from the value of the stock going up. And this is where that buy low, sell high thing comes from. Those are growth stocks. Now you can have a stock that's both. You know, you might buy some stock and let it grow for a year, earn some dividends, and then sell it. So it can be both. Okay, and then you have preferred stock. Okay, there's preferred stock and there's common stock. Preferred stockholders, if you own preferred stock, you get your dividend income first. Okay. It is usually a set amount. And it's not frequently changed. So perhaps a certain company would have their preferred stockholders are going to earn a $2,000 a year dividend period. So what will happen is the company will take the profits and they'll pay the $2,000 dividends to all the preferred stockholders. If there's any money left, then the common stockholders will get it. So common stockholders are paid after preferred stock. So they receive the dividends. Okay, you receive the dividends after the preferred if the money is available, right? Because if they pay off the preferred stockholders, maybe they won't have any left. Also, though, it only happens when the board of directors votes on it. Now, we didn't really talk about the board of directors too much, but corporations that are publicly traded are owned by the stockholders. But that's thousands of people. You couldn't be calling up thousands of people and asking them how to run the company. So the stockholders actually elect the board of directors. So the stockholders elect people to represent their best interest and run the company. It's sort of like a government. So stockholders get 1 vote per share of stock. They elect the board of directors. The board of directors run the company. The board of directors decide if the stockholders get dividends or not. A lot of times they will give you the dividends because you can vote them out if they don't. So they like to keep, the board of directors likes to keep the stockholders as happy as possible because you're voting on them. So it's kind of, yes, they can decide not to, give you the dividends, but a lot of times they worry that then they lose their job. And people on the board of directors make a lot of money and they don't want to lose their job. Okay, the other thing, if the company goes under, so when a company goes out under, they have to sell all their assets. And what will happen is they'll sell everything they own, like buildings, equipment, whatever. They sell all that. And then they pay off their debtors, their bills. And then if anything's left over, the preferred stockholders get it first. A lot of times, though, if the company is going under, they're probably not going to have a lot of money left over after they sell off their stuff because they're probably highly in debt. So, but if they do have money left over after they sell everything, then the preferred stockholders get their share first, and then if there's any left over, then the common stockholders would get it. How does dividend income work? There's common stock that pays an annual dividend of $2.13 per share. If she purchased 700 shares for $45.16, what's her annual income? Okay, don't let too much information confuse you. The dividend is $2.13 per share annually, and she's purchasing 700 shares. So I'm going to take 700 and I'm going to multiply it by $2.13, and I'm going to get $1,491 per year from that stock. Okay, Elsie owns 2,000 shares that pays a quarterly dividend of 51 cents per share. Okay, so $2,000 shares times 51 cents is going to be $1,020, but that's per quarter. Okay, quarterly dividends is every 3 months. And there are 4 quarters in a year, just like there are 4 quarters in a dollar. So you get that 1020 and you multiply it by 4. So she'd get 4,080 for the whole year. But she'd get 4 different checks. Yield, we are going to take the annual dividend income per share. And we're going to divide that by the current price of 1 share. Which is going to give us a decimal, which we're going to convert to a percent. And to do that, we move 2 spaces to the right. Okay, so if I want to find Kristen's yield, she has an annual dividend of $1.40 per share, and the price is $57.40 per share. So her yield is going to be $1.40 divided by $57.40. You get this decimal, and if we move 2 places over, she's going to get a 2.4% yield. And again, as I was saying, the highest interest rate I found last year, I haven't looked at this year, but the highest interest rate I found last year was like 1%. This would be much better than that. So it would be better to have your money here. Yeah.
So you just go up to the 10th?
Yeah, usually we go to the 10th, unless otherwise specified. Yeah. So let's go back to Roberta. Her dividend was $2.13 per share, and the shares were $45.16. So I could find out her yield by doing that $2.13 divided by $45.16, which I didn't do yesterday. So she's getting a 4.7% yield. That's really high. So her dividends are really high. We can't figure out this one because we don't know the per price share. You have to have the per share price. You have to have the per share price to find the yield. If you don't know the per share price, you can't find the yield. Is that good? Is. Okay, Beepco pays an annual dividend of $1.20. Today they closed at $34.50 with a net change of negative 50 cents. We want to know what the stock's yield was yesterday. So first we have to find out yesterday's price. Well, today it was $34.50, which was down 50 cents. Remember that, our down arrow? So yesterday it was $34.50 plus 50. So yesterday it was $35. That part okay? All right. So now we know yesterday's price. The dividend's the same. So I'm going to take that $1.20 and divide it by $35. And I'm going to get 3.4%. Now, if I wanted to, I could compare yesterday's yield with today's yield and see how much that affected me. If I wanted to do that, I would take the $1.20 and divide it by yesterday or today. which I, again, didn't do. So I do $1.20 divided by 34.50, 3.5%. That doesn't make sense. Oh, yeah, it does. Okay. Yeah, so yesterday was 3.5%, or today is 3.5%. So my yield is actually higher. Does that make sense? The yield is the dividend price compared to the per share price. If the per share price is higher, you're dividing by a larger number, so you get a smaller percentage. If the per share price is lower, you're dividing by a smaller number, so that makes the percentage larger. So it's a comparison, basically. So if you have a high dividend with a low per share stock, you're getting a bigger yield. So sometimes the stock price being high is not necessarily going to earn you the most money. Does that make sense? So sometimes if the stock price is low but the dividend's good, you're going to make a higher percentage on your money. Dividend splits are the same as a stock split. So it works the same as a stock split. Okay, so if it's a 2-for-1 stock split, that means I get 2 shares from my 1 share. And they're half the price, right? They're half the value because the total price stayed the same. Do you remember, guys, that? So it's going to be the same thing here. I'm going to take that dividend. If I have half the value, so I'm going to take that 214 and I'm going to divide it by 2. And I'm going to get $1.07. Or you could look at it as B over A times the dividend. So this would be the formula. Old dividend. So the new dividend, it would be B over A times the old dividend. Corporate bonds. A bond is not the same as a stock. Okay, there's corporate bonds and there's government bonds, and government bonds are not the same as corporate bonds. But a corporate bond is a loan to a corporation. And they're less risky than stocks. Okay, they're paid back with interest. Usually the interest is, well, always the interest is at a set rate, sorry. And it's usually paid annually or semi-annually. Okay. We're not really learning about this, but I'm just going to let you know the difference. A government bond, you buy the bond for a set amount, and then after some amount of time, you get a different amount that's higher. So like maybe you buy a government bond that you pay $50 for, and it's a 10-year bond, so you give them $50 and then in 10 years they give you $100 or something. You know, I don't know the exact prices, but government bonds work a little differently. You don't earn interest along the way. With a government bond, you buy the bond, you hold on to it, and then when it's time, you sell it back, and you get money. With a corporate bond, you get interest along the way. So you might have a 10-year bond. You're going to get interest every year for 10 years. Your face value is the amount that you bought the bond for. So this is the amount of the bond. It's the purchase price. It's also the money you get back. At the end of the time period. And at the end of the time period is when the bond matures. So that's when the loan comes to an end. Basically, the corporate bond and the government bond do the same thing. You give money and you get more money back. The difference is with a corporate bond, you get interest along the way, so you're getting money every year or every 6 months, whereas with a government bond, you get all the money at the end. And a corporate bond, you get, like if you buy a $50 corporate bond, you get $50 back at the end. But you've gotten money along the way. So that's the difference. The other thing you should know about bonds, if you buy a bond, you are not any kind of an owner in the corporation. Bonds do not give you any ownership right. A bond is a loan. I'm giving this company a loan. They're going to pay me back. That's it. That's the only thing they owe me is my money back. So I don't have any voting rights. I don't get dividends. It's because I'm not an owner. If I buy a $1,000 corporate bond and it pays 5% interest per year, I'm going to take that 5.7%. I don't want it in red, sorry. I'm going to take that 5.7% and I'm going to turn it into a decimal. So I'm going to move the decimal 2 places to the left. So it's 0.057. And it's a $1,000 bond. So I'm going to take that $1,000 and I'm going to multiply it by 0.057. And I'm going to get $57 per year in interest. Now let's say it's a 10-year bond. Okay, I'm going to get $57 per year times 10 years, so I'm going to earn $570. I have given them $1,000 and I've gotten $570 extra back. So that percentage would be, hold on, I'm trying. Okay, so that percentage would be 570 divided by 1,000. So it's a 57% return.